The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So let's jump in then to really going through the other side of the equation, the law of supply. Supply is of course, the direct relationship between the price and the quantity supplied. So for those producers of a certain commodity or any financial asset, of course, or service that is supplied, that has a very direct relationship to the price. Increased price causes increased quantity supplied. Adversely, decreased price causes decreased quantity supplied. Related to cost plus pricing model, as quantity increases, cost often increases, so higher prices are needed to increase quantity. Okay, so I hope that makes sense there. We see the law of supply, of course, when there is less supply in one asset, of course, that's going to liberate a certain amount of price change with a direct relationship to the price as the supply chain moves. So again, quantity increases, costs often increase, so higher prices then are needed to increase quantity. And then we can explain this simply by looking at a very similar table. Let's try and graph exactly what we see. So we see price per unit again. We see our axes again, similar to our demand curves. We have our price per unit at 5 the whole way down to 1. Again, as we have a quantity demand of 12,000 units, the price per unit is of course 5. So it's becoming more attractive. If a product is released to the market and it's meeting demand, buyers are of course demanding that, well, you're going to raise the price of that product because it's profitable. And that's the same as the financial markets. And as we move down through the prices, of course, we can see the price per unit from these initial supply markers are much less. So market supply is represented as a shift of the supply curve and is caused by changes in determinants of supply other than price. So very similar to the non-price determinants of demand, we have a similar function in graphing supply again. And here we see again the supply function here from our supply curve. It's inverted, so it shows you the direct relationship again as prices move. So again, let's look in terms of defining our increase and decrease in supply. And again, it's just a very similar function, but showing the other side of the market again for those creators or producers of a certain product or service. Again, it explains the direct relationship between the price and the quantity supplied. So the quantity produced or given as output to the market. And again, when we see products that are services that are experiencing very low supply, we're going to see a very sharp move in those prices if there's going to be a certain burst of demand or a certain increase in supply injected into the market. So again, this is what we see in terms of the shift. We have a relative quantity supplied again as a factor. Our supply shifts. This is an increase in supply, producing more of a good or service into the market, and adversely a decrease in supply when perhaps there's a drought for a crop like corn or cocoa or any of these commodities. We're going to see a decrease in supply. What is that going to do to the price? Of course, it's going to put the price up on these asset classes. So let's discuss then the non-price determinants of supply. Very similarly, again, we have technology, prices of other or correlated assets, expectations again on those supply factors, and the number of sellers, of course. So the more sellers that come into the market for a similar good, the better. The better it's going to meet, and more specifically, if there's a high level of demand, but there's a shortage, of course, we're going to see very high prices for that particular good. When there are more sellers coming into the market offering the same product or good, of course, they're going to be able to meet that demand, and there's going to be more competition for such demand, and that supply demand function will then negate that factor, and prices will start to drop to finally settle on a level of market equilibrium. So that brings us really on to defining a fair value as market equilibrium, and let us jump into market forces in much more detail. Well, in defining supply and demand, we need to obviously discuss the changes with their interaction together. The changes or shifts will disrupt the equilibrium price. Now, the equilibrium price is simply the fair market value price for any good or service. The market will adjust until once again an equilibrium is reached, or a new market price. The equilibrium price and a quantity traded will of course change. So here we have both sides of the market. We define it as a shortage. So when there's a shortage in the market, there's excess demand. Occurs when the quantity demanded exceeds the quantity supplied at the current price. Competition amongst buyers eventually bids up the price until equilibrium is reached, again at a higher price. So again, there's shortage. There's not enough goods to meet that demand. There's either a huge shortage in supply, or there's excess demand, and that's of course going to create a very high price level for a certain product. Now, to give you an example, there are firms that actually operate like this, simply to function in terms of competition. And I'll give you one example. Prada, they actually create Prada handbags and price them very, very uniquely, but they actually limit the supply of bags to the marketplace so that they are able to brand as a luxurious good, or a good of that extent to actually brand in such a way. Then when we have surplus, we see excess supply in the markets. Occurs when the quantity supplied exceeds the quantity demanded at the current price. Competition amongst producers eventually causes the price to decline until equilibrium is reached. So there's too much supply basically, and what happens when there's too much supply? We're going to see drastic price declines. Again, the very knowledgeable, the very obvious example to use is the oil market, because it's very relative to us as traders over the past 10 years. It wasn't so long ago oil was trading above $120 per barrel, and of course when the Americans started to develop fracking, which was a process of drilling down into the earth, they found large resources of oil and a new process to extract that oil. We found a new influx of supply of that commodity into the market globally, and it created way too much supply, far too much excess supply to actually meet global demand in oil prices, and obviously we've seen a huge decline in such that commodity. So this is effectively what we see as the markets start to operate. We have our supply and demand shifts, both moving left and right, and they'll constantly move in terms of new news flow entering the markets, dictating new changes in price structures. So when we see an increase in demand, prices increases and quantity decreases. Okay. When we see decreases in demand, prices decreases and quantity increases, and adversely increases in supply, prices decreases and quantity increases. And last but not least, of course, when we see a decrease in supply, so we're seeing less supply invoke into the market, the price increases because there's too much demand meeting that trying to chase that good or service, and quantity then decreases. Okay, quantity will increase, then price change is now determinant. Okay, so there are overriding factors in the supply and demand function that dictate price movement, but what we see as traders, or what we try and focus on, is simply the price movement, when in fact, guys, the price movement is the final result. It's the end result after all of the other price determinants. Okay, so I hope that makes sense, and this is how we can start to better price certain assets that we're able to trade, and obviously that's the end goal, to dictate price movement. The overall change in the indeterminate side of the market is obviously the price or quantity depends on the relative shifts in demand and supply there. So from our demand increase or expansion in demand, there's going to be an assertive price change. And again, from a retraction or a decrease in supply, there's obviously going to be a very strong change in pricing that asset. And here we have market equilibrium, just as discussed. So market equilibrium is what we try and dictate as economic agents, all of us as market participants in trading any asset class whatsoever, whether it's a commodity, whether it's a Forex pair, and particularly if it's a Forex pair, given the amount of volume, the amount of participation, trading and transacting these foreign exchange pairs, we ultimately accept that the current price, guys, upon trading any asset class is effectively market equilibrium. Again, if we are equity traders, perhaps we see something as mispriced. That's a different story, because we define with our own analysis a level of fair value, and if something is underpriced, and then that's of course a trade, a fundamental trade we can take. So you can see how defining the logistics of the supply and demand functions can actually benefit your idea of price discovery, and obviously try and follow those trade movements. So this is what we see in the middle. Obviously, I'll just highlight this and annotate this with a little more detail here. This here, market equilibrium, is effectively the perfect hypothetical market price at any given moment. And then what we see is changes in the supply and demand structure of any asset class. So for one, perhaps we have excess supply entering the market. We're going to have a market surplus. There's just simply too much of any commodity or too much of any product or service for those buyers, those market participants who are trying to meet demand, but there's simply too much of that commodity or good or service that there's going to be a market surplus. Effectively, that's what you see in many of these commodities. Again, you have commodities like cotton, wheat. They really are stored in terms of, if there's a large yield, they're stored in large warehouses to account for that market surplus. And then there's market participants that try and dictate price demand when there are certain shortages. And that brings us on then to, you can see the other side of the function. In between our supply shift with the contraction in demand, there's effectively a market shortage there. And when we have a market shortage, of course, it's the exact opposite. We have too many buyers chasing too little goods, and that creates, basically what that describes is scarcity of these natural resources. Again, not just a natural resource, it can be a Forex market, it can be any particular financial asset that is being priced according to fundamentals of supply and demand. So let's sit back for a while and we can really discuss hypothetical trading options to actually bring all of this together, to look at asset classes, to look at particular markets in question. Well, I know that maybe one asset has a certain level of seasonality. Perhaps during a harvest season, there's a large demand for that product. Perhaps if you're discussing petroleum-based products, there's more demand in the summer. For a driving season, of course, more particularly in the US, of course, that is the case. Perhaps it is something like this, observe it in front, where we can discuss the price of gas itself and how it actually affects itself in terms of where we are in the course of the year, whether it's a seasonal trend or there's just a huge shift because of another factor, perhaps a large producer, Russia perhaps, or Qatar, another large producer of natural gas, evidently decides to change their level of output. That is something that we can understand very, very, I suppose, very obviously, and look to trade or benefit from any sort of knowledge in terms of how that will relate to an increase or decrease in demand or supply. Okay, so we have an event to be analyzed here. Again, a totally hypothetical event, and we'll try and tune it into actually looking at price action. The event to be analyzed is an increase in the price of gas. Okay, so without knowing why this is going to actually cause an increase in the price of gas, we see the step one has a demand curve shift. Okay, so effectively demand shifts here from left to right, from D1 to T2. Effectively what that does is create a new structure where quantity 1 is now quantity 2, and that follows again the supply curve. So the amount of supply that can be met by increasing the quantity demanded by all market participants is going to create a new price from price 1 to price 2. Okay, So then step 2, obviously we see that demand shifting right and the relative price change. Now the question I would like to ask is, well, how does this affect the market in which we trade? Okay, so we do understand that there are non-determinant changes in demand, non-price determinant factors that will change, of course, but we know, well, the move has happened. There's an increase in the price of gas. Why is that the case? And how does it relate to trading? Well, let's actually look at the chart here and we can try and formulate a few ideas here. Well, we're trading natural gas here. We can see the price actually move from left to right. It's trading on a range there for quite some time, albeit with some volatility. Perhaps there is some market participant that wants to move into the market and change the structure. Again, the question is, could this candlestick represent a simple demand shift in the price of natural gas? Now, why would that be the case? On the technical side, here is our point of reference. So let's say we'll put a question mark right here. Is this our change in demand? Is this effectively when we see demand curve shift from D1 the whole way to D2? Again, as we follow such price movement, well, there's going to be a level of supply again, and effectively the price again, if you relate, has actually changed now to P2 from the initial move. So again, the reason why I ask that on the technical side is simply because we can see, well, we are trading in these price channels again. As the price channel is broken, we see an effective change right at this price that one institution or one nation perhaps or one producer could have changed the overall fundamental function of the supply and demand area. Again, it's a totally hypothetical question, what could have happened here. Again, it could be the fact that we are trading natural gas. I know as a trader, of course, that we often see a very large increase in natural gas prices or a very large increase in demand for natural gas relating in price increase during the months of November, December and January. And as the spring starts to come in here across Europe, we then see it filter off and we can see a very, very sharp decline in prices after that demand retracts, or there's effectively a contraction in demand, what we call a contraction in demand. So again, that could be the case here where we see demand shifting. Something has clearly happened. We are over the months of winter perhaps, where people like to heat their homes. Of course, there's a large influx of demand over those winter months. And then when we get into springtime, we effectively see a complete shift in sentiment, in demand, contraction of the demand curve, causing a very, very direct change or inverse change in the supply and demand function according to price. And again, we actually see this trend reverse to the downside. So this could be a total fundamental trade that you could prepare for. Of course, it happens more specifically in the natural gas market according to those demand and supply functions over the winter months. And of course, it is relative. Seasonality is very much a thing for commodity markets as well for those fundamental traders. So again, let us discuss how these markets operate in accordance with supply and demand. We have markets in competition. Now, what we assess the markets that we trade is, of course, with efficient market hypotheses that we suggested was a very determinant factor for free markets. That, of course, there is fair competition across asset classes. And of course, the more volume there is in markets, we can use again the Forex markets to present this theory, is that there's a high level of liquidity or participation. Therefore, of course, markets are competitive. A market, of course, is a group of buyers sellers of a particular product or asset class. The competitive market is one with many, many buyers and sellers. Each has a negligible effect on price. In a perfectly competitive market, all goods are exactly the same. Is that the case? Buyers and sellers are equal, so numerous that no one can affect market price. Each participant is a price taker. So is that the case? Can we assume markets are perfectly competitive? If that's the case, we're all price takers. We have to simply take the price that we get. Well, in a sense, more specifically for us trading small account sizes, of course, we're not institutional traders. As such, we don't have access to huge amounts of capital that we can move prices in markets. It is most certainly the case for most of us. Prices are completely competitive, and we have to take those prices. We are price takers, of course, in a market where there is high volume, high liquidity, and a huge amount of market participation between buyers and sellers, effectively dictating price both on the sell side and the buy side. That's in terms of defining competition in market. Now, of course, the supply and demand function will relate to that level of competition within those markets and how resources are effectively allocated throughout the globe. So that brings us on then nicely actually to discuss then how prices actually allocate resources. So this is not more organically, this is not something that we think about in terms of defining price discovery. We know that, well, perhaps price is rising because more and more people want to buy it. Is that simply the case, or why is there more demand now in Australia for a certain asset class than there is here? Well, it's actually more often the other way around, of course. It's actually prices that allocate resources. If there's one nation that effectively has a very high price or a very large demand for that commodity, it's going to dictate a level of interest in actually exporting such an asset to that nation. In market economies, prices adjust to balance supply and demand. These equilibrium prices are the signals that guide economic decisions and thereby allocate scarce resources. Okay, so let's use a real practical example now. And again, I like to use the oil example because it is so practical to explain how these prices actually allocate resources. So again, let's use OPEC as an example. So OPEC, again, the Organization of Petroleum Exporting Countries here. Again, they are a cartel of countries that like to a certain extent, influence the price of oil through their own manipulation of export and import, or changing the supply and demand function of the commodity, the oil commodity itself. So here, OPEC, we have countries rich in natural resources. They're faced with local excess supply. Okay, so does that make sense? So let's choose a country like Saudi Arabia or Qatar. They are relatively small countries in the large scale of the globe, but their number one resource is a natural resource. It's a commodity like oil. Certainly in Ireland, that is certainly not our premier commodity, and we have a level of scarcity for that product. But their whole economy, for a large extent, relates to the price of oil. If they were to create a lot of oil locally, well, of course, there would be just huge supply of that oil. There would be local excess supply for such a product. So what they actually do is, well, there's of course interest from countries around the world that need that resource. So it's effectively, a two-way street where other countries who don't have such excess supply or local supply will create demand, which will meet that balance to actually look to price and allocate those resources accordingly. So here we have, of course, the OPEC countries able to manipulate price, of course, but they have supply. They're in control of supply, evidently, to a certain extent. So we'll use a few examples here. We have Japan has a very low supply of local oil. So they're not big producers of oil. Local oil prices would therefore be relatively high if they were also producing a very low amount. And Japan must demand oil from major exporters. So of course, on their balance sheet, they are very large importers of oil. Their supply and demand function is heavily orientated on the demand side, but that's okay. They offer other goods and services that create value to the world, and obviously run our economy more diversified. To choose another example, we have India. It has a very high population and is among the world's largest importers of oil. To meet that demand can be met with sufficient outside supply. Of course, there is sufficient outside supply, so it's not as if we are really seeing this scarcity of resource. Of course, this might be a discussion 300 or 400 years down the line, but for India, of course, they can choose to do business globally in the oil markets to simply trade off a refraction of price from OPEC and other nations that are large producers. So they're very much meeting that demand or creating that demand, and effectively these countries to the right hand side are creating that demand side function to the overall underlying surplus there across the world. Australia again is a completely different example because Australia has its own oil supply but allocates resources by both importing and exporting oil. So if we relate back to our market equilibrium, we can see, or we can gather an idea to effectively where these three countries, where Japan, where India, and where Australia, where they are along that demand and supply curve in terms of allocating this commodity and the resource across the globe. So they're all effectively part of the function of supply and demand, even though perhaps Japan, let's say, isn't producing a lot. It of course is a big player in the function of supply and demand because it's creating a lot of demand for the product. And this is effectively how prices are commodities are actually dictated across the world through this function, and how prices in turn allocate resources. Okay, so then just to summarize then, economists use the supply and demand model to analyze competitive markets. The downward sloping demand curve reflects the law of demand, stating a firm correlation between quantity demanded and price. Besides price, again, we defined non-determinant price factors. Supply and demand depends on various other factors, including buyer incomes, tastes, different expectations, the prices of substitute products, etc. If one of these factors change, well, obviously we're going to see a relative change across the demand and supply curves. They're going to shift. And then in free markets, prices are the signals that guide economic decisions and allocate scarce resources. Therefore, all tradable asset classes are subject to the laws of supply and demand. Okay, so the choice for us, of course, if we're deciding to be fundamental traders or technical traders or both, of course, it's all going to lend itself to actually having a better sense of what moves markets and what news flow will actually create maybe a contraction of supply or an increase in demand, expansion of demand. You're going to know initially, well, that's going to have a relative effect on a particular asset class, more particularly if there's a large producer of a product, like the Saudi Arabian countries or the Emirates there. If those OPEC countries, for example, want to really limit the supply side of the equation for that commodity, there's going to be a huge factorial change in pricing that asset. And the fact that you can know and insert some knowledge into that trade decision allows you to take advantage of such a price move as a trader. So that brings us to the end of today's Become a Pro lesson. Of course, congratulations. That brings us on to week 2 now. So we've finished the first 5 lessons. That's absolutely fine, and I'd like to welcome you then and see you tomorrow at the same time for lesson 6 as we go through a more in-depth economic functions of financial markets. So thank you very much for joining us here on this episode of Forex.Academy Become a Pro course. Thank you so much. We'll see you then tomorrow. Bye for now.